No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. My name is Hank Parrott, your host. We're going to be talking about a number of things today. I have a whole stack of things. This is the kind of stuff that I read through. This is what I do for fun. And I wanted to share some of these with you this morning. And part of it is getting into the whole part about retirement and the different things that can impact our retirement, the different things that are going on in the country, the different things that affect the economy, the different things that can cause inflation to be higher in certain areas. If you think about inflation as an example, this is one of those areas that's kind of hard. We don't think about it. We don't necessarily see it every day. It's one of those that kind of sneaks up on us. They used to say that high blood pressure being the silent killer. When it comes to your finances, inflation is the silent killer. And the way this works is that we see these prices going up. And now the government will report something called CPI or CPIU, so the Consumer Price Index, Price Index Urban. And what this does is it takes this basket of goods and services that are that they use to say this is how much things are going up, and it's down at around 2%, give or take, let's say. Now, the reality is, though, that the things that are in there aren't things that we necessarily, like example, TVs or appliances, things that we may pay for every 10, 15, 20 years. As opposed to the everyday items that we use. So when we think more in terms of food and gas for our cars and, of course, medical expenses and how much these things are going up, clothing is another one. If we just looked at that narrower basket of where we actually spend our money, we would see that inflation rate to be much, much higher. Medical, as an example, is probably somewhere in around, I think, 6 to 7% a year range, if not more. In fact, I just got my new renewal rates for our company plan. And for our health plan, it's going to go up, I think it was around 9% this year, and that's been one of the lower years as far as increases over the last like 4 or 5 years. So one of the things when it comes to retirement and planning is about your money, right? We need a certain amount that we set aside in our operating fund. This is where the money comes in each month, and we're using that to pay our bills each month. The second one is an emergency fund. We need like a money market, savings checking, something where we have money set aside for those unknown things, right? We don't know what's going to happen, but something always happens, and we need this money right now. We don't need to have to worry about market downturns, so you don't want to have an emergency fund invested in the stock market, as an example, or tied up in an annuity that may have penalties, you know, or even a CD for that matter, over the next 3 to 5 years or longer, and you couldn't get at the money you need. So we set that aside first. And this is one of the things of understanding investing in general and a good financial plan is you start with a stable foundation. So we've got an operating fund. So let's say you spend $5,000 a month or $10,000. It doesn't really matter, whatever that number is. So we'll start with 5. If you got $5,000 a month to cover your standard of living, then that means you need $5,000 in your checking account, all right, just to cover the bills, and that needs to be a running balance. And you'd need about $30,000 set aside as an emergency fund. And then we get into a short-term fund, and the short-term fund is going to be based on what kind of things you may be needing over the next, say, 2 to 3 years. And that fund is one that you want to have relatively liquid. You can be a little conservative. You can do some things with it, but again, you don't want to get into a long-term investment portfolio. And I'll get into how the investment portfolio part works in terms of stocks to bonds as a way to determine your time horizon for how you invest. All right. So let me explain a little bit. If we're looking at a short-term fund, that's a fund that's, say, 1 to 5 years at the outside, maybe 1 to 3 years on one level. So we could basically break it into 2 parts. So this would be if you know you're going to need a car, let's say, in the next 2 to 3 years, then you want money set aside for that. If you're going to do some big home remodel, or you've got you want to renovate your home, or whatever it might be, or maybe just some things that are, you know, big expense items like air conditioning or a roof or something you're going to need in the next few years. That's money, again, you want set aside. You don't want to tie that up, let's say, in a long-term fund. So an example would be if I wouldn't put it in a 60-40, 60% stocks or 75% stocks or more. I wouldn't put it in a portfolio that's aggressive in the stock side. for money that I'm going to need in the short term. That would be more appropriate for money, let's say, that's you're going to leave invested for over 5 years. The reason for this is the volatility in the stock market. So if you understand how the volatility in the stock market works, here's the way this is. You're investing maybe in a 401k, an IRA, TSP, thrift savings plan for federal employees and military, 403b, 457, all these different retirement plans, and you've got investment options, mutual funds and the like. Well, asset allocation is going to be the biggest determinant of what kind of return you're going to get, and it's also going to be the amount of risk you're taking, the volatility measure. So it's not when you're looking, and this is unfortunate, but when you look at the reports that come for your 401k as an example, and they show your different investment options, one of the things they show in there is they'll just show the returns, right? They'll say, well, over the last, it might give you a year to date, it might give you the last 3 months, and then it'll give you 1 year, and then 3 years, and 5 years, and 10 years, depending on the history of the fund, of course. And you look at those returns, and you maybe just say, well, maybe you're thinking, well, I need some of this and this, and you're looking at the returns and making your decisions solely on that. What's not shown is the standard deviation, which is a measure of risk or volatility in that fund. It's what will tell you how much those funds may drop when the stock market does go through a bear market period or even a correction. It'll give you an idea relative to the market how much you could expect. So an example would be the S&P 500 index has a standard deviation of 15. Okay, over the last 10 years. If you look at it longer term, like over the last 40, 50 years, that standard deviation is closer to 18 to 20%. Now that means a lot of volatility, a lot of ups and downs in the market, a lot of time. Okay, so we don't mind it, of course, that like right now we're in the second longest bull market in history, and since the election we've had this huge run up in stocks, and it seems to be going on for who knows how long, right? Well, one of the things there is we don't mind that kind of volatility. It's that other volatility. It's like what happened from 2000, 2002 when the market dropped 45% over that period. Or from October of 07 to March of 09 when the market dropped 55% over that period. We hate that kind of volatility, right? So that's where it's important to understand that, guess what? You can control the volatility based on your asset allocation. In other words, based on which mutual funds you're choosing. And one of the first places you start is how much you have in stocks versus how much you have in bonds. So if you've got 50% in stocks and 50% in bonds, then the expectation would be that you would have half the risk of the market. All right, that's the expectation, but it has to be done correctly. Because here's the other part, and I see this a lot of times when new clients are coming in, people coming in for the first time, they're bringing in their investment statements, their brokerage statements from whoever they're using right now, or if they're doing it themselves. And when I look at those and I say, look, you've got that 50-50 stock to bond mix, but you've got the risk of still, like the S&P, your standard deviation, in fact, is very close, if not even in some instances higher than that of the S&P 5, the market itself, the S&P 500 index. So you got the right idea in the 50-50. The problem is if you've got long-term bonds or junk bonds, and you may not know if your advisor is saying, hey, this is a good mutual fund, I think we should do that. Or if you're just looking at your 401k statement and you're seeing, oh, this fund, this high yield corporate bond fund has done real well over these last few years. Let me go ahead and put my money in here. And let me just tell you that high yield corporate bond, that means junk bond, okay? Those are low credit quality, higher rate of default, problematic. Other things you can get into are longer duration bonds, and I'm going to talk about this in more detail when we come back. I want to cover a lot of things today, but this part is going to be so important to you, all right? Right now, when the market's doing so well, this is a time, again, to look at where you're positioned so that when the market does go through a downturn, and it will, all right, when it does, you're going to be positioned to be protected and to protect all these nice returns that you've got up to this point. So we're going to talk about that and a whole lot more today. Join me here. We're going to take a quick break, and we'll be right back on the Retirement Report.
This is a Storm 5 HD weather update. Sign up for Weather Call at newschannel5.com.
Hi everyone, I'm Storm 5 meteorologist Leland Statham. Again, rain-free, so no reason to check out radar. So let's check out the regional temperatures. We're going to be between about 75 and 80 for highs a little bit later in the day. Here's what's happening right now at Nashville International, along with sunrise and sunset times for this Friday. Let's show you what's happening now. Overall today, 78. That's above the norm. Normal for you is right around 70 degrees. Then for tonight, mainly clear. Good weather for football tonight. 81 tomorrow. Rain chances picking up during the day on Sunday. Chance of rain Sunday afternoon. The better chance of rain Sunday night into Monday. During that period, many areas could end up with 1 to 2 inches of rain. Then much cooler weather is on the way behind the front. Thank you very much for watching News Channel 5 Plus.
Are you looking for an easy way to do your taxes? Dr. Friday here. I can help you keep more of what you've earned. With over 20 years of experience, I can help you minimize your taxes. I'm an enrolled agent. That means I'm licensed by the Internal Revenue Service to represent you. Whether it's your personal or business returns, I know the ins and outs of the tax code. I'm on your side. Learn more of what I can do for you by calling the number on the screen or go to drfriday.com.
The time has come to enjoy your golden years, but have you saved enough?
I'm Hank Parrott. Don't just survive in retirement, thrive. Call me today at Estate and Financial Strategies or tune in for the Retirement Report each and every weekend on News Channel 5 Plus.
What if you could rewind your day? You wouldn't get stuck in traffic or get caught in the rain.
Showers develop.
Start your day moving in the right direction.
Don't want to be stuck.
No, before you go.
Morning, everybody.
Watch News Channel 5 this morning.
You've been smart and saved for your retirement years. But now what?
It can be an overwhelming puzzle to see the big picture, but it doesn't have to be. I'm Hank Parrott of Estate and Financial Strategies, and I can help you thrive in retirement, not just survive.
Estate and Financial Strategies can help you maximize your wealth while minimizing your risks. Here's what we mean. To thrive in retirement, you need to maximize your Social Security benefits and your returns on investment and minimize taxes and the effects of inflation while planning for health care costs and increases in the cost of living.
Yes, you can thrive in retirement and not just survive, but you have to take that first step. Be one of the first 10 callers to my office to receive a comprehensive financial plan at no charge. This is more than just a free consultation. It's a full, comprehensive financial plan. Believe me, you can thrive in retirement. Don't just hope to survive. Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I was just quickly doing a little recap of some things I like to talk about on the show with regard to investing. And this is one of those areas, again, about staying ahead of inflation and, of course, evil taxes. Okay, so one of the things when it comes to inflation is you need to make enough to stay ahead. And again, we talked about the differences between the different inflation tables, and everyday price index, I think, is one of the better ones, where we deal with the things more of what we actually spend our money on versus these longer term things, the everyday stuff. So one of the areas of staying ahead of inflation taxes is how you invest. One of the ways you invest is how you put away money for your retirement, which of course has to do with retirement accounts and that. And we're talking about within 401ks, the kind of choices you have and how we just get to see the returns and not necessarily the standard deviation or the risk that goes along with those returns. And when we're looking, and I mentioned high yield corporate bonds as being one of those things, which has junk bonds in it, which is a very risky play. Another area is these longer duration, where you can get into bonds that are 20 or 30 or anything over 10 is long term. But typically I see 15, 20, 30-year bonds, and it could be 30, 40, 50% of the bond mutual fund invested in these long-term bonds. Well, these are going to be very interest rate sensitive, meaning that as interest rates continue to go up, the stock, rather downward pressure is going to put on the bond prices, so your original investment is going to lose money. All right, so as interest rates start to heat up and we see them increase, that's one of the big dangers and concerns there. And so where bonds might normally give us that negative correlation, meaning that they balance out the volatility against stocks and can help reduce our risk, if they're long-term bonds, that's not going to be the case. If they're junk bonds, that's not going to be the case. So the key is that we want to use what are short to intermediate term bonds as a way to give us that control of volatility in the market. In other words, now when we have a 50-50 portfolio, if we've got the right type of bond funds in there, yes, then we can in fact reduce the risk relative to the market. The next is how we blend together the stocks. That's another way that we can reduce it down. This is all covered in Dr. Eugene Fama. He won a Nobel Prize in 2013. His 3-factor model I covered in my book, 7 Steps to Financial Freedom in Retirement. And speaking of that, here's what we're going to do for the first 10 callers to my office this morning. We got a special offer for you, right? 615-376-5325. That's the number you call. That's the number on your screen. If you would like a free retirement income analysis, which includes an investment analysis, this is where I cover a lot of things I talk about with you personally. Take a look at your current investment plan, your current asset allocation with your company plans, and show you how these things work within your plan and within your particular situation. So in other words, what's the needed rate of return on your money? We determine that. Then we can put together the actual investment plan that's going to help you attain that goal. So a free retirement income analysis includes investments. We're going to talk about Social Security, your overall planning, you know, what you have for income, what you have for expenses, what you have for assets, liabilities, all of that. All you need to do, if you'd like to get this plan at no cost to you, 615-376-5325. Again, I have to limit it to the first 10 callers. Call my office. Tess is standing by to take care of your call. She'll gather your information. She'll send you out a checklist of things to bring to your appointment with me, and we will do up a full comprehensive financial plan for you. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. This is almost 30 years of my practice. I've developed basically I share stories in there about how I've helped different clients, how the type of planning works. So these are tried and true strategies that I've used over many years to help people do just that. Attain and maintain their standard of living and their quality of life, never have to worry about running out of money, one of the biggest fears we all have, and make sure that you're going to be okay in retirement. And again, this is a personalized plan for your specific situation. So again, be one of those first 10 callers. 615-376-5325. All right. Now, I'm going to share, this is, I covered this now, I'm going to go through a bunch of different things with you this morning. So I'm going to go through this stack of stuff, right, to share with you. This is one, it was in Wall Street Journal. Jason Zweig is he's a really great writer, been doing it for a couple of decades, I think, if not 3 decades maybe. In one recent survey, wealthy individuals said they expect their portfolios, you ready for this, to earn a long-run average of 8.5% annually after inflation. Now, how realistic are your expectations? Think of this for a second. 8.5% is what they're expecting to earn after inflation. So that means they're looking at a 10 to 12% annual rate. In fact, as he said, with bonds yielding roughly 2.5%, keep in mind, treasuries are what, about I think a 10-year treasury is somewhere around 2.25 right now. A typical stock and bond portfolio would need stocks to grow at 12.5% annually to hit that overall 8.5% target. Net of fees and inflation, that would require approximately doubling the 7% annual gain that stocks have actually produced over the long term. All right, it's not, this is the problem, and it's not just individuals, all right? Now, I don't know what your investment, what you're thinking. I know when I ask people how much you want to make on your money, they're like, well, as much as I can. Well, if you lost half of it tomorrow or all of it tomorrow, would you be okay with that? Well, no, I don't want to lose my money. So we narrow it down, because the riskier the asset, or typically the riskier the investment, the greater the potential reward. Not always the case in portfolio design, though. You can be taking a lot more risk and not be getting paid nearly as much as what you could be if you had a different asset allocation. So one of the things we get into is determining, well, what's the needed rate of return? How much do you actually need to make on your money to never run out of money, to be able to maintain your standard of living, quality of life? Throw in some fun money, right? We want to factor that in too. So we start out determining your base. First off, how do we maintain your current standard of living? All right, so we measure that. We do that with what are your expenses? Where do you spend your money? How much do you spend over the course of a year, averaged in monthly, for each month, to be able to maintain your current standard of living? Once we have that measure, then we add in inflation. We can see how much you'll need to make on your money to be able to maintain that, because we see, well, there's your expenses, here's your income, here's what you're going to have from Social Security, or maybe you're already getting Social Security. If you have a pension, fewer and fewer people do, but that would be factored in. How much you have saved that's going to be able to provide you income. Do you have any other income sources like rental properties maybe, or annuities that are going to be bringing in income? You know, all of that we factor in when we're doing up planning. And we determine from that what's the needed rate of return. And we start out low. We want to see, well, what if you had a portfolio that's very conservative, and let's say you're making 4% on a conservative portfolio, maybe only 20 or 25% in stocks as an example. Maybe you're very risk averse and you don't like a lot of volatility. And that might be something we look at to start. And then we look at 5% and 6%. We want to keep it based on what the actual returns are, though. So an example, understanding the S&P 500 index over the last 10 years has averaged about 7.5%, 7.46, I think. So if you look at the S&P 500 index, now that is the 500 largest companies, of course, in the United States. They make up 70% of all the money that's in the stock market. And here's the other kicker, right? Tony Robbins talked about in his book, and they, you know, depending on the period you're looking at, anywhere from 80 to 95% of the time, it's going to that index in fact is going to beat, all right, active managers. In fact, here's a couple of recent articles. This one from Indexes. This is from, I believe, the Wall Street Journal. Yes, Wall Street Journal. Indexes beat stock pickers even over 15 years. Okay, so again, an S&P 500 index fund outperforms the people that are out, the actively managed mutual funds. Wall Street Journal again, Wall Street Route. Indexes beat stock pickers 92% of the time. All right, think about that. So that S&P 500 index fund, in other words, is 500 companies that we're just buying it. We're not trying to figure out which one's going to do better than the other. We just buy them all. That's an index fund. You can do it with an index ETF as well, exchange traded fund. What we're looking to do is we want to invest in the market in such a way that we get a broad diversification. We have, and I'm going to talk more about asset allocation, how that fits. Right now we're just narrowly on one asset category, and that's large cap, a blended large cap fund like the S&P 500 index. Very low fees on it. Great way to go here. It's going to have, though, a lot of volatility. And what we now want to do on building up portfolios, we might start with that as one of our core holdings, but we're going to build around that and help reduce that volatility so that we don't have to worry about big drops, being awake at night worrying, is the market going to do this for 1 year, 2 years, 3 years? What's going to happen? How long is it going to take? Is it going to take 5 years, 6 years, 7 years to recover? What am I going to do in the meanwhile? We're not going to do any of that. When I do planning with my clients, this is one of the things we take out of the picture. When you think of it this way, when you have the market as it did in 2000 to 2002, it recovered, took 5 years to recover after that. That means you were in the market for about 7 or 8 years before you got, you know, from that beginning point to where you started making money again. And then we go through 08 and 09, right? We go through that bear market period. Now you're in the market for like 10 years plus, and you've not made a dime. If you're lucky, you're at break even. And that's if you did as good as the market, right? As good as the S&P 500 index. And what did we just say? Indexes beat stock pickers 92% of the time. That means that most people that had mutual funds or maybe were doing it themselves did even worse if they stayed in the market in that period, if they were, you know, had the discipline to do that. This is why it's so important to understand how these things work and to have an advisor that's on that understands this as well. Because if your advisor is pushing active management, as I just said, indexing is going to beat that. So what are you going to do? Okay, how are you going to, in fact, navigate this in such a way that you're going to be okay? It starts with making sure that you've got the right advisor, of course, right? And we're going to talk about how you can determine that and how you can, in fact, put together these things when you're looking at your 401k as well. But first, we're going to take a break. So join us here. We'll be right back on the Retirement Report.
With